Walt Disney reporting their latest earnings after the close-in bell. We've got Doug Flynn, certified financial planner and co-founder of Flynn Zito Capital Management, with us to kind of go through things. I guess we start with Disney because that's kind of the story today. Let's talk about these results. It seems to be really still focused on ESPN and the loss of subscribers. What are you expecting?
Yeah, it's well, the whole thing is going to be based on how they've stemmed that cord cutting that's going on. They've got a lot of increased costs with the NBA deal, so it's really contingent on how they do with that. I think the whisper numbers are that they'll come out at $1.56 or so of earnings. They're estimating $1.53 consensus. So if they really surprise to the upside, you could see some movement here. But this stock has been basically flat the entire year, where the market's had a really nice run. So
you have a negative expectation for the ESPN component of the Disney numbers, is what you're saying.
I do.
You really don't expect a positive story
I'm hoping
here.
At some point they could turn it around, and that would really do well for the stock longer term because it's such a widely held stock. But if they continue to have problems over there, it's going to continue to suffer. The stock hasn't moved, and it's mainly because of that. ESPN suffering at this point.
We'll see. One analyst writing that potentially because they're getting onto these skinny bundles, that could help ESPN, whether it's Sling Television or DirecTV Now or the PlayStation. So I'm hoping for a bright spot with these numbers with Disney. Certainly we care about that stock, but I do want to talk about overall the markets. You're looking at what we got last night, obviously, which was another record close for the Dow, another record close for the S&P. We have had now 52 record closes since the election for the Dow in particular. But the question keeps coming up, is that in jeopardy if Washington can't move forward on the agenda? Where do you sit on that?
I'm in the camp of that. You know, whenever you have Washington not doing a lot, it's probably a good thing because you get some certainty in the fact that you can rely on earnings, and earnings are really what has been driving this market. When you do a deeper dive into the market and you look at the growth versus value, the growth stocks versus the value stocks, growth stocks are up 20%, value stocks are only up 5%. The market overall is up over 11, so there is a lot of room there, and earnings, even though multiples are a little bit on the higher side, they're not so outsized. And if you get continuous earnings growth, as we've seen, and the outlook looks good both in the U.S. and internationally, that bodes well for the market to continue from here.
Well, sure. I mean, you had 75% of companies reporting in the S&P 500 that have beat either on revenue or EPS. But let's talk about, in particular, some of the sectors that we're watching. I think technology is really interesting right now because if you look at one of the leading sectors yesterday for the markets anyway, besides consumer staples, again, it was technology. So many analysts and naysayers have come on and said that this group is overpriced, overvalued. What do you say about tech?
Yeah, you've had the FANG stocks and all the tech stocks are really what have been outsized. And again, that's where the technology and the growth stocks have really run. And that typically runs for a little period of time before it's, I don't expect a big downturn there, but I do expect a more normalizing of returns. You can't have 20% year-to-date returns continuously. Some of those other stocks will catch up and outperform. Like last year, value stocks outperformed growth. It's flip-flop now. So they'll run, but again, it comes down to earnings.
You know, it's interesting because one of the things we haven't seen in this market with all these new records is we haven't seen volatility, and that seems to be a good thing. I've never seen confidence, I don't think, so high than we've seen in this market in 2017, Doug.
That's more concerning to me than anything. I think you want to have some. You want to have some volatility. There are people who I think maybe were afraid of Trump and got out of the market, and they're still waiting for the entry point to get back in, and that's completely passing them by. So they're waiting for an excuse to get back in the market. There's still a lot of money on the sidelines. I think 5% corrections we haven't had in a while. A 10% correction, those things are healthy, and that weeds out some people, and then it gives people an entry point, an opportunity to get some of that money to work. So I think there's more room here. I would hope we'd have a 5 or 10% correction.
Okay,
there's a lot of money waiting. Yes, exactly.
You're right. I think a lot of people are still kind of licking their wounds from the Great Recession, obviously. Doug, thank you very much for your perspective.
Absolutely.
All right.